we think the Fed is probably overdoing it. The global economy may not be able to take too much more.
Celebrity investor Cathie Wood believes we are standing on the brink of a global recession, and that's on top of serious recession indicators we're already seeing in many industries. With companies like Walmart reporting their inventories are up 32% after the company drastically overestimated demand, and the US reporting its first quarter of negative GDP growth, which puts us halfway into a recession already, since all we need are 2 consecutive quarters of the economy shrinking for us to officially be in a recession. And Cathie Wood's not the only one who thinks things may be going south.
Jamie Dimon at JP Morgan talked about a hurricane. Be prepared for a hurricane. Elon Musk said that he has a super bad feeling about the economy.
And in comments at a conference in May, Elon Musk went as far as to say, "I think we are probably in a recession, and that recession will get worse." But what are these big investors looking at that tells them that there's a recession coming? And more importantly, what can you do to protect yourself when the next one hits? So hey everyone, and welcome to FinTech. In this video, I'm going to go over exactly why Cathie Wood thinks we are headed for an economic collapse, talking about why we've been seeing crazy high inflation and how that could ultimately lead us to swing the other direction toward deflation and an ultimate recession. And we'll be using a very simple framework to explain what's going on: hot or cold. We've recently been in a white-hot economy with tons of free money and rampant inflation across sectors. You've probably noticed if you've been to a gas station in the last few months. And while most people would like the economy to cool down a little bit and lower the overall inflation rate, we're starting to see warning signs that we may swing too far from an economy that is white-hot with inflation to one that is made ice-cold by overstepping from the Federal Reserve. And at the end of the video, I'll get into some strategies that you can use to protect yourself when the next recession does come. So hit the like button if you want, and we need to start out by understanding why we've been seeing such high inflation over the past year. So we probably all remember the massive money printing by the Federal Reserve that kicked off the start of 2020, where the Fed ended up creating $4 trillion out of thin air to help businesses and individuals through stimulus checks. But while this may have been a necessary step to stabilize the US economy as people lost the ability to leave their homes, it had the side effect of inflating the overall money supply in the country. M2 money is the measurement of the money in the economy, so things like cash, checking accounts, money that's sitting in your stock brokerage but not invested. It's actual liquid money that can be easily spent. And in this chart from the St. Louis Fed, we can see how M2 money shot up basically in a straight line at the start of 2020. This had 2 basic effects. Number 1, it made money much more available to people who needed it. And number 2, it made people value that same money less. Simple supply and demand says that there is always an equilibrium between how much supply of something there is and how much demand there is for that item. Ideally, we sit in this equilibrium right in the middle, and the price of the good is stable. But if the supply of something suddenly increases, the demand does not automatically increase as well. This causes the price to drop as the supply increases. Think of it in terms of trading cards. The more common the card is, meaning the higher the supply, the less valuable it is. And that's how you get people like Logan Paul owning a rare $5 billion Pokemon card. Now, when we're talking about dollars, the price is always $1, but the value that represents can get pushed down if we have an oversupply of easy to obtain cheap cash, which thanks to the stimulus, we do. But that's still only half the story with inflation. After all, the Fed slowed its money printing all the way back in November 2021, and yet inflation is still going up, with the CPI or Consumer Price Index recently hitting a new high and reporting prices are up 8.6% since a year ago. The other half of the story, which is even more important for figuring out if we will see a recession in the near future, is the supply chain. The global supply chain was completely disrupted by COVID, and we're still seeing the effects of that now. At one point in December, there were 96 ships full of containers of goods sitting of Southern Californian ports waiting for their turn to be unloaded. Chip shortages started hitting everyone from car companies to makers of smart appliances, and the prices for commodities like lumber and oil hit nearly all-time highs during the last 2 years. Those supply chain shocks had a huge cost to them, and that cost carried over to the rest of the economy, inflating home prices, making running a business more expensive, basically costing more to do anything productive. It drove prices across the board upward, and when everything costs more money, well, that's just another word for inflation, something that took Fed Chairman Jerome Powell months to admit when he stopped classifying the rising prices we were seeing as transitory. But while the supply chain issues had a big impact on on inflation up to this point, which remember is a sign of an overly hot economy, it's about to play an even bigger role in pushing the world into the icy conditions of a recession. And in a recession, it's a good idea to take free money when it's available, which is why the Moomoo investing app is now giving you 6 free stocks when you sign up and deposit $1, 7 free stocks if you deposit $100, and 10 free stocks when you deposit $2,000. And that offer ends at the end of the month, so make sure to sign up using the affiliate link in the description below. Okay, let's get back to it.
As I've said many times, we think the greater risk by far is deflation.
But you're talking over a longer time horizon.
I'm talking about now too.
Up to now, we've been talking through how there's been money flowing through the economy and huge pent-up demand from supply chain issues, causing the economy to run too hot and causing the high inflation that we've been seeing recently. But now Cathie Wood is worried about the exact opposite: deflation. Deflation is where the value of a dollar actually increases over time rather than decreasing, which sounds great on the surface, but it's probably the worst thing that could happen to the economy. In a deflationary environment, prices fall day after day, which in turn leads to decreased consumer spending. Why would I spend $1 today when it will be worth even more tomorrow? Most people tend to start saving more money during deflation. This then causes companies to start slowing down their production, which in turn could lead to huge layoffs or salary reductions. Eventually, the entire GDP of the country can suffer. And remember, if we have just one more quarter of negative GDP growth, that is a sign that we are in fact already in a recession. But why does Cathie Wood think deflation is coming? Well, there are two main forces that she sees pushing us toward deflation. There are the short-term cyclical forces and the long-term secular forces. So let's start out by talking about the short-term forces, since those are going to be the most pressing over the next few months. Now, cyclical forces in general are just forces that repeat over time. These are things like bull and bear markets, or the Fed changing interest rates. And the first major cyclical force we need to look at ties back to those supply chain issues that we talked about, and that is rising inventories for companies. Well, during COVID, companies were struggling to get enough product to customers due to those supply chain issues. They just started producing as much product as they possibly could, hoping to get something out onto the shelves. But now that those supply chain issues are starting to clear up, we're seeing a rebound where companies have too much inventory built up. And that has Cathie Wood worried.
I've never seen inventory surges like this in my career, and I've been around for a long time.
Walmart's inventory is up 32% and will take at least a few quarters to clear out. Target is slashing prices to clear out their excess inventory while canceling future orders to suppliers. And as Cathie Wood said,
these are crazy numbers for two of the best managed companies from a supply chain management point of view.
So if even Walmart and Target are needing to cut prices to clear out inventory, other less well-managed retailers may have even bigger issues and will need to cut prices even more. And cutting prices over a long enough time period is just called deflation. But the other cyclical force is even more pressing for investors like Cathie Wood, and that is the Fed intentionally raising interest rates. Fed Chairman Jerome Powell has indicated they plan to raise rates to, quote, restrictive levels. And they have already raised the rates to 4 times higher than they were a few months ago, from 0.25% to 1%, which might not sound like a big number, but it is a 4x relative change in interest rates, which has a bigger impact on the economy than you might realize. When the Fed raises interest rates, it basically does the opposite of printing money. It cools off the economy. So if we keep seeing record high inflation, we would want the Fed to help us cool down. But we were just talking about how we're seeing deflationary forces, and if the Fed is too aggressive with their moves, they could accidentally cool down the economy too much and drop us into the next recession. And with the S&P 500 down nearly 20% this year, the market is clearly not reacting well to the Fed raising interest rates. And beyond these short-term impacts, we're also seeing secular forces of deflation, which in the long term may end up having an even bigger impact on the economy. Now, I won't go into as much detail here since this could basically be a full video on its own, but innovation is inherently deflationary. Improving technology makes things less expensive over time. Now, that might seem counterintuitive. Why would innovation drive prices down? After all, iPhones seem to be getting more and more expensive every year. But think about it in terms of a single product. If I buy a phone this year, it will be worth less next year and the year after that, because new innovations in phone technology make old ones less desirable. And with technologies such as AI, genomics, blockchain, EVs, all being worked on in parallel, these could combine to create an exponential effect on lowering prices. But that's still not the end of the story. While the Fed is under pressure to reduce inflation, there's even more pressure that may arise as the US starts to enter midterm elections in Congress, potentially setting us up for a ticking time bomb in the economy. So the midterm elections take place 2 years after the president is sworn into office, and this upcoming election is coinciding directly with a pretty perilous time for the US economy, where we need the Fed to balance on the razor edge between slowing inflation and not crashing the economy completely. And Congress may feel pressure from the public to do more to address inflation. According to a study by the University of Michigan, consumer sentiment about the economy is the lowest it's been since the 2008-09 crisis. So the worry here is that politicians are going to feel pressure to do something as they go into their midterm elections to try to win over public favor. And the most obvious target for them is inflation. US President Joe Biden recently published an op-ed in the Wall Street Journal titled "My Plan for Fighting Inflation." And in it, he laid out 3 main methods he would use against inflation. Number 1, and right in the subtitle of the article, Joe Biden will not meddle with the Fed and he will let them do their work. For now, that means that he will let the Fed continue to raise interest rates unopposed, since that has been their strategy at this point. But it's unclear if the Fed becomes more dovish and stops putting the brakes on inflation, if Biden would still be happy with them, or if he would try to step in and pressure them into making more dramatic moves. Number 2, Biden plans to pull the US government's deficit down. Now, normally the way they do this is to raise taxes, which in general doesn't really happen during election years, so that's probably going to be more of a future effort. And number 3, Biden will try to whittle down everyday costs of things like healthcare and energy. This might involve investing more into renewable energy as an example, which will help decrease inflation because remember, there's a deflationary effect to innovation. But again, it won't have a major impact this year. That's more of a long-term solution. So fundamentally, it all comes down to this giant balancing act by the Fed. Lower inflation enough to stabilize the economy and keep the public happy, but don't push it too far where the economy completely collapses and we enter a recession. In fact, we have an example of the latter seemingly happening in China right now, which is exactly what I talked about probably happening in this video from 6 months ago. But that teeter-totter between a hot economy and a cold economy, between inflation and recession, isn't necessarily the only option. We could wind up in a situation like we saw in the 1970s, where we had both a stagnant economy and rampant inflation. This combination would mean prices get higher and higher day after day, while people aren't making more money or producing more goods, which is a really bad place to be. Now, currently the job market still seems strong, so it's unlikely we would hit that particular economic speed bump, but I thought it was worth mentioning. But now that we know about what could lead us into a recession, let's talk about what you can do to protect yourself today. So I'm going to give you 3 tips on how to protect yourself before and during a recession. The number 1 thing to do in preparation for a recession is to pay off high interest debt. Now, I know that it is obvious, but here's why it's so important. Debt is essentially risk with no upside. If you lose your job or your net worth declines due to a recession, you still have to make the same monthly payments on your debt. The bank or credit card company don't really care. Plus, if you have high interest debt, like the $6,000 average credit card balance in the US, or the average $30,000 owned on auto loans, that is guaranteed going to be costing you money every single month. Meanwhile, investing in cryptos or stocks, while it could have upside, is not guaranteed. But a lot of people make the mistake of going for guaranteed downside for the possibility of upside, which is even less likely during a recession. Number 2 is to dollar cost average into the market. For example, you could put $100 into the market every week. The reason you do this is it kind of evens out fluctuations in the market over time. So sure, sometimes you'll be buying high, but sometimes you'll be buying low, and by consistently putting your money in, it will average out over time. This is an especially powerful psychological tool during volatile times, since you won't be tempted to try to time the market, which pretty much every study out there says is a losing strategy. And if you have access to a tax-advantaged retirement account like a Roth IRA you can put money into, that makes the benefit even greater. Now, number 3, and the most important thing you can do to protect yourself during a recession, is just to not make any hasty panic decisions. They say mistakes love a rush decision, and that's doubly true if you're scared of losing money during a recession. If the market drops 10% overnight, I don't want to panic and sell. If it goes up 10%, I don't want to take out a second mortgage to dump money in. Sometimes the right decision is just to make no decision at all. But if you are going to make big investing decisions, make sure it's based on reasoning and not fear, because fear will get you hurt every time. I know that every time I've tried to make an investing decision based on emotions rather than reasoning, it's always come back to bite me. Make sure to grab your 10 free stocks from Mumu. Don't forget to like and subscribe, and I'll see you next time.